So we are introducing a new series, a second new series tonight. I think, as I mentioned before the last session, that we are trying to match pitch nights at Keystone Sessions up with a new series called Capital Conversations. If you don't see our strategy there and trying to get the investors in the same room as the startups the same night, then I can't help you. But this is our first Capital Conversations. I'm going to let the two individuals to my right introduce themselves here in a minute. Our goal every month will be to get someone from the risk capital community, the regional risk capital community up here, to talk about what it means to be funded in Kansas City, what those organizations are seeing in terms of startups, and then really try to use their expertise to the extent we can to help entrepreneurs understand what they need to be doing, provide valuable feedback for them on how to pitch, how to make those connections, do those types of things. So I am honored to be joined by the two individuals to my right, based on their experience, I've known them for years, and I'm excited to have the conversation. So, Sherry, I'm going to start with you. If you want to just introduce yourself and talk a little bit about what you do, that'd be fantastic.
Great. Thanks for having us. Sherry Turner. I've been in the entrepreneurial space as a support organization for more years than I care to count. And, I haven't left it mostly because there's so much that there's been energy at different times in the 18, 20 years I've been doing it. And it's an exciting time and things aren't fixed. So we would just want to keep fixing them. So I actually am a part of something called 1KC for Women, which includes the Women's Employment Network, the Women's Business Center, and the Women's Capital Connection. And I think most of our conversation would be access to capital on the debt and equity side tonight. I'll let Jeff introduce himself.
Hey, I think I know several of you from Sandbox days, so good to see them again and good to see the pictures again. I'm Jeff Shackelford. I head up the Enterprise Center located in Johnson County, but working across the region. So we're not bound to be on the Kansas side, and many of the companies and folks we work with are across the entire region. We're home to the Mid-America Angel Network. It's a network of about 75 individuals who invest as one entity. So we bring 2 to 3 companies in per month to pitch to this group, and then they, as a group, decide if there's enough of them that want to make an investment, we'll then make an investment in an early stage company. We typically like to see companies that have a product in the marketplace. It's a big marketplace, have some traction, and really are looking for some money to kind of start to scale and grow. You want me to touch on WCC, or you want to talk about that?
So the Women's Capital Connection actually is a part of the Mid-America Angels Network. And the reason we started a women's group is because 14 years ago when we started it, we were only one of 6 nationally that were focused on women-led companies with a gap of 10-to-1 ratio of male-led to female-led receiving equity funding. So we felt it trying to fill that gap in the Midwest. We took on the challenge, and here we are 14 years later with about 40 women investors, because we're educating women about how to be angel investors, and then working with women-led entrepreneurs in navigating equity funding.
So home to Mid-America Angel Network, home to Women's Capital Connection. We're home to a mentoring program called Growth Mentoring Service, which is an MIT-based program that we license. It's really for folks been around a year plus or so, want to grow to the next level. We'll form a team of experienced, seasoned mentors, it's always 3, to help them put that plan together, execute, and grow to the next level. We run a program called Equip for Equity. So those folks that have never raised capital investment, we run them through the language you need to know, these things called investment instruments that you're probably not familiar with. What are they? Safe notes, convertible notes, priced equity, so on and so forth, as well as preparing them for what is due diligence. If you're going to raise money particularly from institutions, you're going to go through something called due diligence. Most people don't, in their regular life, never run into that. So we help them build a data room, get that set up. It's important that you don't come across as a novice when you're raising money, because the larger institutional investors don't really want to educate you. They want to write checks and send you on your merry way and hope that you grow quickly. So we run those programs. The Women's Business Center that Sherry and her team runs is the only one on the state of Kansas. Is there the WBC in Missouri? There isn't one. Okay.
No, there's actually one in Columbia and one close to Springfield and one in St. Louis.
Okay, well, as a Jayhawk, nothing good's in Columbia. So
no, we don't say that here, Jeff.
Hello,
we don't say that here,
hello.
Jeff. We don't say
I
that here. And I'm a
disagree with
Jayhawk, but
that.
we don't say that here.
Yeah.
No.
So we run her and her team run that Women's Business Center. They do a Launch You class. So thinking of starting any type of business, whether it's one that could scale and be huge, or whether it's I want to start the corner bakery, or I want to start a cigar shop, or anything along those lines. Launch You helps you prepare. What do you need to know? How do you get prepared? What's it really going to take? If it has to do with, for instance, childcare, then there's a lot of regulations and things you have to do with it. Her team really does a phenomenal job of getting people set up to do that. Trying to think what else.
I got some questions
Go
if you
ahead.
guys want to. Yeah, I mean, like this.
And hey, this isn't church, so you guys can move forward, and I would rather interact. So feel free to blurt questions out.
So I didn't hear you. I think it's still on the website, but I didn't hear you mention Fountain Innovation Fund.
Purposely, you didn't hear
Okay,
me.
all right. Well, maybe I.
Well, the
just-
only reason is, we launched Fountain Innovation Fund a few years back. The concept was it's a true early stage seed fund, meaning you may not have your product in the marketplace yet. You need a small amount. Say you need $150,000, $200,000. Fountain might commit to as much as 75 to 100. Then you have to match it. So it's very similar. I was talking to Roy. Very similar to MTC's idea funds. Well, when we launched it, the concept was we were going to grow it to $5 million. And it was an evergreen nonprofit, so we would make enough investments over a 3 to 5 year time frame to return that capital and keep reinvesting it. Unfortunately, something got in the way of us getting to $5 million, something called COVID. So we kind of put the brakes on it and have not started any more fundraising for it. One of the things we need to evaluate is on the Missouri side, the MTC is getting funded for their idea funds again, which is, again, early stage. Kansas will be introducing a Kansas Growth Fund that also will fill that no more than $250K early investment, single one-to-one match unless you're a minority, women included, then it's a 50% match. So that gap may be filled.
Is that the Network Kansas Fund that's been
Yes.
created? Okay,
Trish,
that's just coming through. Trish Brasted.
Yeah,
down
that would
Wichita,
be.
Yep.
Commerce wants to do a big to-do, so that's why it's not publicly announced. But so if you got those two on both sides of the line, I'm not sure the need for us to try to go do something very similar really
Yep.
exists. And you'll find we're not big on duplicating what exists, so we tend to collaborate with so many of the other entrepreneurial support organizations here that we found if somebody's doing it well, then we just want to hand people off and refer back and forth and not try to reinvent that wheel.
So I know in your introductions, both of you talked about how long you've been at this. So I'm not trying to make this a stab or a dig at either one of you, but you've been around a long time, especially in the region. So let's talk a little bit, just start off with the macro of how you see things in Kansas City or in the region right now from a funding perspective. Because it feels like, I mean, and I think we all understand there's a pandemic and there's been challenges related to that, but like try to remove that a little bit from the conversation. And like, if we were to draw a trend line as to where you think the Kansas City region is overall for entrepreneurial funding, give me kind of your perspective on where you think things stand today.
So I'll at least start from a historical perspective. The market has completely changed in a positive way, and that there's a whole lot more groups, whether you know who they are or not. There's a whole lot more angel investors that have their own groups going. A group will get together and trust each other, and they'll be doing their own deals. And there's pockets of that. So the market is actually stronger in terms of angel investing dollars. It used to be that we were the only game in town when we started this 15 years ago, and that has really changed a lot. There's also a ton of cash. Now, the market's not doing us any favors right now. There might be some investors that are pausing, but I would say overall, we're still seeing our investors invest. If anything, it's making sure that we have the deal flow with an investable company. And those are, because of the pandemic, sometimes these collisions and the ways in which we connect are not have not been as easily readily available.
Yeah, I'll say, typically MAA, Mid-America Angels, we make about 10 investments a year and somewhere around $2.2, $2.4 million. Our average first investment is about $250K in a company, $250,000 in a company. In 2021, we made 10 investments, but every one of them were in a company that was already in our portfolio. And you saw almost all institutional investors hunker down and just keep their powder, as we call it, for the companies they've already invested in, because we all didn't know what the heck was going to happen. That's been somewhat relieved. We're still living through it, but we all believe we're going to live through it, and we kind of can see things differently. So, I'm trying to think. This year we've probably added 3 companies to the portfolio. So we are making new investments in new companies. We always average about the same. About 2.2 million, about 10 investments. There are a lot more investment entities in Kansas City than were here, not to show my age, but in 1996 when we launched a telecom company, there was one tiny investment institution here, KC Equity Partners. That was it. Now you've got KC Rise, you've got Flyover Capital, you've got I can't remember Clausen's early stage fund. You've got a number of funds that have started and have money. So there is capital. I always say capital is not the issue here. It's good teams, good ideas, and investable companies that are the issues here on both sides of the state line. We need more programs to generate more early stage entrepreneurs with really good ideas to feed that funnel. But I'll also tell you, it doesn't really matter where you get your money. From our sandbox experience, I think they're up to now a couple, probably 200 grants have been given, and those companies combined now. I think last time I talked to Joe Meyer, it was almost up to $180 million that they've found in add-on funding. I would argue that when I was there, 50-70% of that came from outside the city, which is awesome. There's nothing better than bringing capital from Chicago, from St. Louis, from Minneapolis, from Denver to the city to invest in startups that are going to grow here and create jobs. So, people get hung up with, I want to raise my money in Kansas City. And I'm always like, a dollar's a dollar. Go get it where you can. We syndicate with Nebraska Angels, Great Plains, which is in Des Moines, Rocky Mountain Venture, Accelerate Venture in Wichita, 2 in Oklahoma that I can never remember their names, and one other I'm forgetting. So we will syndicate. If we see something that looks good, that's somebody that's raising $1 million, we'll only put in $250 to $300. We'll say, hey, let us introduce you to the Nebraska Angels. Let us introduce you to RVC, and go get the money. Go get it from other places. Just bring it here and stay here is what we look for.
Yeah, I want to come back to that in a minute. So let's just talk about it now. So we still see a lot of founders where money is tied to program. So whether it's an accelerator or whether I think in Tulsa there's a few programs where they're surrounding the entrepreneur with mentoring and other, it's not just the investment, it's the resources that they provide. And so we're still seeing, what I would call startup leakage out of the market for capital. And so, how do we think about that? And is this tied to your deal flow? Like there's a deal flow shortage, or there's a teams and, solutions shortage here? Are those two things tied together that we need more programming to keep them here? Or
I think,
can we separate the capital from the resources, the non-capital resources?
You and I and others and Sherry and I think Maria Myers and all of that conversations, we have a dense ecosystem here. We've just not done a good job of weaving it together. I'm big on, if you were to go get a grant out of, when we launched the Sandbox in 2013, my thought was we're going to give out 25 grants a year. I'll have time to spend with each company. We can get them connected and so on. The volume grew too quick, so quick that we need to do a better job. If you get a grant like the Sandbox, where do you graduate to? Who picks you up, right? And that next group or organization may only pick you up for, if it's accelerator type, 90 days, 120 days, whatever, 6 months. Where do you go from there? I view it as college, right? You go to college and you enroll in a 100 level class. Well, when you're done with that, you go to the 200 and then you go to the 300 and 400. We need to do a better job of, hey, I came out of whatever organization. What we do is we say, congratulations, we've graduated you out. Go find where you're supposed to go next. It shouldn't be that way. It should be a path. You go here, you go here, you go here. And almost to the point where those programs need to get to the point of go, if you're coming in, we expect that you came out of here. If you didn't, there's probably an interim that we ought to get you in, because you're sort of not going to have the background or the understanding you need to get the maximum benefit out of this program. So we'll put you here, and then you come. And, a lot of times, as a lot of entrepreneurs want to jump. Yeah. I'm ready for, somebody to way down the road, which is detrimental to them, because you're going to see somebody who goes, you're not ready. And then the next time you call them, they're going to go, I've already seen you. Yeah, but I'm different. Yeah, I've already seen you. And so I think we have to figure out, as you're trying to do here, right? How do we get a cross section of organizations? We're typically on the Johnson County side, right? But doesn't mean we shouldn't be here.
Yeah, I see that font getting smaller in your signature line, though. So I appreciate that. I do appreciate that.
There are no county commissioners here, so I can say that we should be called just the Enterprise Center, and we work across the region. Unfortunately, from a funding standpoint, I have to cater a bit to the county. But we try to, especially sharing her group, we try to develop programs that are not bound by Johnson County. I mean, you know better than me, maybe 50% of the clients, 52, 53% of the clients we work with are Johnson County. That means the other 47, 48 are across the region.
Yeah, so I want to add, though, we're still Midwest, right? I mean, let's be honest with ourselves. There's still angel investment that goes on here. Those angel investors are not like the coastal angel investors that are in the seed stage, the real seed stage, the thing that's the biggest gap for our region, and probably not just Kansas City market, but the entire Midwest. It's a little bit more conservative thinking. And so angel investors here are really looking for deals that already have traction, when on the coast, it can be, pre-money deals. And I think we have to be honest about that.
I've seen angels in Kansas City that are a little bit more inclined to invest like a coastal investor. They're just not doing it here. They're still they're investing in those opportunities in other markets. So how do we get more of those here? Because the money's here. Mm-hmm. So how do we change that mindset, or how do we get them to stop making those bets in other markets and make those bets here? Does that go back to this? We don't have the programming structure to stand up the deal flow that would matter to them?
I think two things. One, we don't have enough early stage teams and concepts that you can pick and choose, right? You see so few. They go, that might. Okay. Secondly, I'll speak for Mid-America Angels. We've been around 17 years. Many of our members have been in it for 17 years. And no offense to them, but in 17 years, you've probably made the 8 to 10 early stage investments you're going to make. You may be at an age in your life where an 8 to 10 year payback horizon no longer excites you. We have to get the next generation. I say late 40s, early 50s, probably still in their career, built up their 401k or whatever that plan, and they want to take that 5% and play in a high risk, high reward space. Sherry, but what we have to do that is we have to put tools in place and as quite frankly, re-engineer the angel group. And that's not unique to us as we talk to others. The angel investment world has changed. The model may not fit like it used to.
Yeah, I hear rumors there's going to be a bunch of millionaires rolling out of the new Oracle Cerner deals. So it seems like a new angel network right there.
Yeah, half jokingly but half serious, that's exactly right. We've got to figure out how to get to that group and say, look, take that 5% of your portfolio and play in this space. And COVID kind of kept us from we used to do a bunch of educational stuff. What is an angel? Why would you be one? If you're an early stage entrepreneur, how do you attract them? What do they look for? All that just got shut off. And we've done no new member drives. We've got to find more. We have a chapter here, Kansas City. We have a small chapter in St. Joe, small chapter in Topeka. Both of those could grow double in size easily if we put the effort there. And then here, try to find that next group of people, and then Women's Capital Connection continues to look for those women that enter a position to want to make those types of investments.
So I'll add, it's been frustrating for us too in managing the groups, right? Is thinking, especially when we think a deal that's really a seed stage deal is like, on fire, and we'll get those in front of the investors. there are some very sophisticated angel investors in our community that understand seed stage and know that we should be investing there as an angel investor. There's just not enough of them to influence the rest of them. But to your point about, there's people doing deals on the coast and participating out there. Some of those are people that transplanted here. They still have relationships out there. And so you invest with who you're comfortable with or who is a pal or a buddy. But we're working on that a little bit because half the time we're educating more people about angel investing and how to become an angel investor, because we don't have a huge bandwidth here. It's not huge.
So, Sherry, I want to stick with you. So, where are you getting deal flow locally now? Where do you source deals? Where are you seeing, I don't know, the best deal flow and, other options? And where do you think our major gaps are there?
Well, pre-pandemic, I would say the deal flow was better because of the same reason those of us that work in this space were not colliding as much, right? So it's getting better in terms of just being able to find each other and know about companies. That syndication that Jeff talks about is very strong. And so some of our deals aren't necessarily right here in Kansas City, but they're regional. It could be Kansas, Missouri, Nebraska, whatever. And sometimes we've even been able to recruit. So I would say it's starting to pick up even more now.
So I think you both are aware that when we brought Techstars to Kansas City, it was an interesting education, I think, for Kansas Cityans about what accelerator programs or those organizations that run those large accelerator programs truly are. They're VCs disguised as programs. They're all about the deal flow. How many cohorts can we run? How many bets can we make? We can make bets 10 at a time. We can surround them with resources and so on and so forth. We don't, in Kansas City, we have yet to find local institutional investors that want to invest in that kind of deal flow programming. What do you think that is?
Sorry.
I told you there weren't going to be any tough questions. I might have lied.
He's got this one.
We can discuss as you mentioned, the effectiveness of the accelerator versus it's a deal flow, right? Meaning, you come to the accelerator and you stay. Are you really working on your product? Are you really working on getting customers? Are you really moving that stuff forward? And many times, what we saw here, they weren't. And so they, I half cynically said, you come out with a really great 3-minute video and hopefully you can pitch. But from a traction standpoint,
right?
And our investors here want to see traction. What we really lack, which is why we tried to start Fountain, was almost all of the models that work that are Fountain-like and worked were seeded originally by the state. The state put up $5 to $8 million and said, go fund true early stage stuff. So you come to me and you go, I have a concept. I don't even have an MVP, but look at this. If we think you have a good team, they'll make those investments. What we see in our investors are, I want you to be further down the road, which I think then makes it harder to keep the funnel full, right? So you're always searching for good deals versus, hey, I'd love to have more people coming to us and we say, we can't get you in front of the group for 3 months, right? That's not the case. So, my better than me, I thought on the first cohort of Techstars, there were no Kansas City companies. And I thought it's difficult to bring 10 companies here and not have somebody in the room when you say, I just want to go find a decent sushi. And people go, well, I don't know. I've never been here. I don't know. So I think you got to supplement with, and then I think the next few, you always had a couple, right? Because if I'm here, like if you took me and put me in the accelerator in Chicago and I needed a resource and I don't have anybody in that group that can help me find it, I'm kind of lost. So I think there's some kind of balance that you have to figure out of, hey, what are the local companies that we should be including to attract. Now, I'm not sure if you're familiar with what Nexus is doing in Wichita. They bring them in just to make connections. If you're a healthcare or startup, Blue Cross and Blue Shield, we're going to make a connection. That I would love. I've talked to them about how do we do that here? How do we bring people in and say, if you're in this space, then when you come, we know you're going to sit down. If something that could potentially play in the engineering space, right? Or you're going to see Kiewit, Black and Veatch, Burns and Mac, and some smaller ones. We already have those relationships. You're not going to go in and ask them for investment. You're going to go in and tell them what you're doing and say, how could it apply to your business? And B&V is trying to do it a bit with their own little model. But
Yeah, and I don't want to make this about accelerators and how that programming works. I'm not a fan. Just to be clear, I'm not a fan of the accelerator. I think the accelerator is dead. I think we moved to venture studio models, and they're multi-corporate, multi-partner venture studio models where you get exactly that, and it's more tying them to platform, customer, partner. Like that's the hook, not let's perfect the pitch and get you in front of a bunch of investors on demo day and good luck and we'll see you next year.
A company like Roy's Hip Hop, right? When we first in a perfect world, I saw him at Sandbox. I hate to admit how many years ago, we would have connections to go, well, let me introduce you to superintendent that runs Shawnee Mission Schools or Kansas City Public Schools or Kansas, because they're the ones that time that product seemed to be the fit. Go see them or somebody on their staff and listen to what they have to tell you, because that's going to be your customer, right? And that to me is more valuable than the 3-minute video.
Yeah, no, without a doubt. So that's a great follow-up conversation for us to have at a future capital conversations, or maybe even offline, because I got some ideas on that one. I want to talk about this because I think so many times I hear founders or startups chasing after venture money, talking about equity and cap tables and all those types of things. I've started to see the pendulum swing a little bit more towards what like Novel's doing, towards revenue-based models, or towards, hey, let's stand you up with a sustainable business where you don't have to go raise, even where it might take you a little longer, but you're going to be able to grow your company in a more organic way, which is probably healthier in the Midwest or in the other things. But there are options available to startups that aren't equity-based. So let's talk a little bit about the Enterprise Center Capital Hub that you've got here.
Yeah. So in fact, this is laid out on the bar over there. You really hit it. It's like there are so many different ways now, and even angel investors are looking at revenue share models, right? Even for those that are further along. But it really is about educating about at what stage are you and what resources do you have with credit lines and we've already talked about some of the programs in town that are more grant driven, but there's just so much more with Kickstarters, and there's ways in which sometimes you can bootstrap that are completely different than what it was 5 years ago. So what we try to do is talk about where you're at and not always think about giving your company away just to bridge yourself to a revenue that would get you to maybe a seed round or an angel investment round. So I think that's where we try to play. We're a nonprofit, even though we give angel investment money out. We're basically trying to educate not only the investors but the entrepreneur about other options. So this was just kind of to define what debt looks like and what equity looks like and where they collide, and how at even times where we have an angel investment going on in one of our portfolio companies and they might need a bridge round. Sometimes they don't need a bridge round. Sometimes they could go into a convertible note to get them to the next level. And so these are things that we try to be a part of the community and educating you as an entrepreneur.
Yeah, because I would add, when we say you have to be an investable business, it probably shrinks the total opportunity to less than 20% of the concepts that you really see. And I love lifestyle businesses. I mean, I love a business that could get started and might take them 5 years to grow to $1 million or $2 million, but they're employing 25 people and they're profitable and so on. Those are great. Those are really the businesses that turn areas around.
So how do you define investable in your mind then? So I hear you and I don't disagree. Yeah. And I think that I feel like we've watered down the phrase entrepreneur to include anybody that runs a small business or anybody that runs their own business. And I understand why. what do you use as a definition of investable business? Do you have the power law kind of mentality around what it needs to be?
Some people will tell you, you got to show a path that you could get to 50 million in 5 years, right? I don't know if that's the right number or not, depending on what space you're in. What from an angel perspective, what is important to us is, one, the market has to be that big. Two, how do you get out, right? Which, from a standpoint, if I was starting a business today, that mindset of making me think, how quickly can I get to point to get rid of the business? I don't think is always the best mindset to run the business, right? We as an early stage investors want to get our money out. So I tell people, look, if you're raising $1 million and you're showing me in 5 years you're only going to be doing 3 million in revenue, I can't get my 6, 7, 8, 9, 10x. You're never going to get big enough, right? So I don't know if there's a hard line as much as the particular market segment you're in, who would buy you out or who would acquire you in a sense. That really is industry specific, right? I mean, you look at healthcare, some of these healthcare startups, they're going to have to get really big. People used to stop me and go, when I get to 5 million, Cerner's going to buy me. I'm like, Cerner doesn't even pay attention to a $5 million acquisition.
And it might take them 10 times as long.
Right, yeah. Right. But if you're in a software business, that may not have a lot of major players, and right now somebody's trying to consolidate, you get to 5 million and X number of users or clients, whatever you want to call them, that might be attractive. There is no exact science, if you ask me. I just cringe if I was starting a business today and go, my whole mindset is, how do I sell this and return great investment to my investors? I'm not sure that's always the best way. I always tell people the best way is get traction, get sales, get profitable. Get to a break even, because then your runway is really, really long. And so if you're in a space that's big, the opportunities are going to come for you to continue to grow. And that's the best way to attract investment, right? You're showing traction milestone to milestone. And guess what? They have a path, I'll use Royal Street. I mean, Royal Street Ventures wants to see how quickly can you get profitable, because we don't want you coming back to us for another investment type deal. So I hate to beat around the bush. I just think it's unique. The space that Roy's in is so much different than the space. I can't remember the young lady that has the intelligent dog cage, right?
Yeah.
I mean, that's a niche market that you're going to have to figure out who plays, and you may not have to get that big for somebody to come buy that product.
So Sherry, when you're educating angels, how do you talk to them about, the difference between investing in a lifestyle business and investing in a higher risk, higher return? Like, how do you address this concept of investable business and what we're looking for as an angel group or as an investment group?
Yeah, so one of the most powerful resources for potential investors and entrepreneurs to look at is the Angel Capital Association website. And whether you're an entrepreneur looking at what angel investors are looking at or not, there's some really great data on there. But it's really shifted. 10 years ago, it would say that angel investors were looking at deals that would exit in 3 to 5 years. Well, that's all changed to almost, I think it's like 7 to 10 years now. So the climate is different, but they're most likely looking at a 10x return with an exit strategy. But it's also, there's a mental piece to that. A lot of angel investors, I think it's like 60% of angel investors will invest in an entrepreneur when they believe that the entrepreneur can do what they say they're going to do. And it comes down, if 60% of their decision is based on believing that your pitch and that you know what you're talking about and that you understand your market and that you really do have an exit strategy, then they're betting on the horse, right? And so that is still very prevalent. And that has, so as far as educating our investors or potential people to become angel investors, we're using the same logic so that they understand what the entrepreneur has to do. That's helpful.
No, it's extremely helpful. It's also insightful in terms of what happens in the Midwest, I think, because when we're talking about they have to believe the entrepreneur can achieve what they laid out. If you're not one to believe in big ideas and you're not one to, I've heard this statement so many times that some of the greatest founders are, crazy or that people think they're you're insane until you're not, right? Like when it comes to starting a company or starting a product, how do we overcome the bet on the jockey mentality? We need more of that, right? We need more of that bet on the jockey, but believe in the big things if we're going to see the big bets come off.
Kevin, I've always said if you had a $1 billion idea here, but it took $20 million to launch it, you're not going to raise your money here. You're not going to get that. You're not going to get that kind of money here. You're going to have to go somewhere else. On the coast, if you're Elon Musk and you want to come up with the new electric car and you can get enough people to believe it, you could raise that money. It's Midwest culture. If you have an idea that can be $100 million company and it takes $1 to $2 million to start, you can get that here. But the big, the moonshot that says, man, we got to drop 50 million before we're going to figure out if this thing's going to be $1 billion company or not. That's tough to get here. It's tough to get here.
You think it's never going to happen?
I try to never say never.
All right, fair enough.
But the other thing here, I wish we could get better at successful exits, right? We need those successful, and it's their life and their money, and they can do what they want with it. But we need them to plunk some of that back in, right? I don't want to pick on anybody.
Yeah. Don't pick on anybody.
Yeah.
But honestly, recapitalization is not exit, right? And like some of these things, they're not. We call things exits here that aren't, or we don't see those successful entrepreneurs reinvesting in the community here. And that's
and they invest in other things.
Right.
I know a lot of them that jumped into real estate, and that's a great return and it's great. It's their money, but that doesn't help the ecosystem, right? Building another apartment complex doesn't really help the entrepreneurial ecosystem. I have no idea how you change that because other than we all become entrepreneurs and sell our companies for $1 billion and reinvest in the ecosystem. But I don't know how we change that.
Now you're thinking too big, Jeff.
The other thing I think I've had this conversation, when St. Louis wanted to raise a $30 million early stage fund, they went to Enterprise and Enterprise put 10 of it in. Private company, you can do what you want. We don't have that here. We don't. The Sprint wasn't a private company, so it really couldn't do a lot of things. Kept them from it. We have some large companies or entities that like to put their names on buildings, which is their prerogative, but we don't really have that one or two or three that you go, wow, when you want to raise 15 million and do truly early seed stuff at the concept level, I don't know who you go to. I just don't know where you get, which is why I spend my time at Topeka telling them you should be putting $5 million in a fund and then you watch it grow and do these kinds of things. And MTC's got their idea funds, but even we need more of that. We got to feed, you and I've talked, building an entrepreneurial ecosystem has no end. There's no, we did it. We're there. We've got Keystone District. No, there's no end. And too much of it's cyclical with your political cycles or your funding cycles. And we have to change that mindset that goes, even if you got the Panasonic battery plant that typically can bring 4,000 jobs, the cost per job was $200,000.
Right.
Sandbox cost per job was $1,800.
Right. Yeah, no, I worry that people think that this is going to be the Keystone Innovation District, and it's that same kind of mindset.
Hey, and before I forget, first of all, you came to me early on with what you were trying to do, and we had drinks or two, and I thought you were absolutely crazy because I said,
"Told you."
You talk about herding cats. Herding cats of different species or whatever, and I said, more power to you and good luck. But the fact that you have the first brick in place, which this is the first brick, is a testament to your commitment, to the other people that helped you. And I know how many people you had to shake hands with and pat on the back and do things, but it's a start. So now what's the next brick?
I appreciate that. Zeke, mark this in the video. We got to make sure we pull this one out and publish this one somewhere. So I appreciate that, Jeff.
Literally,
Thank you.
I was like, man, I'll help you any way I can, but this is your thing. I don't have the patience or the tolerance to not say things I probably shouldn't say to people to say.
I still do that. Maybe that's why it's taking so long. So I could continue this conversation because I think there's so much more to talk about in terms of capital, access to capital, what startups should be doing, what entrepreneurs should be thinking about. I have two questions left. I want to start with what I think is the easier one, which is how do people engage with Enterprise Center or how do people engage if they are interested in pitching, learning, being a part of some of the educational programs, how do they engage with you guys?
Yeah, so post-pandemic, we're getting back into the in-person as you are. Just go to the website. It pretty much directs you to all of our activities. You can sign in for our e-newsletter. We're redoing a new website, so we're kind of in that almost early launch mode in the next 30 days. I do want to point out something, though, because those in-person collisions are important. We have an opportunity at the Women's Business Center and Women's Capital Connection to align with a national organization called Springboard Enterprises. They've been around for about 30 years, focused on women-led companies, and they're coming to Kansas City market. We're doing 3 years of events with them, 3 a year. The first one, which was sort of put together quickly, so it's not got great distribution right now, but it's August 4th. And you can go on our website and find out about it. It's called Dolphin Tank. And basically, they created those many years ago, way before Shark Tank was a thing. And there's 3 local Kansas City companies, women-led, but it's open to anyone. And it's very similar to this in that the panelists are investors, and there's a Q&A session, and there's cocktails and food, and it really is just, again, creating that groundswell around early stage companies and equity investments. So happy to have anyone attend. I did send it to you earlier, and Kevin can distribute it to anybody that wants to register for it.
Key there's just cocktails. So show up for the cocktails.
Everybody always says, I lead with sessions, I lead with content, I should lead with free beer. Everybody always tells me that. So
back to your question of, I'm pretty easy to get a hold of. If you don't have my email, jump out on LinkedIn and send me a message. I will spend 30 minutes or so with almost anybody who wants to talk about their business, or how do I raise money, or who do I need to get connected to. I enjoy that very much, so don't hesitate. I've just found I spend a lot of my time just connecting people to other people now, and usually turns out to be fairly meaningful for them, and more productive than me trying to be in the middle of it.
And we have some rack cards up here that we can throw out on the bar here before we leave as well.
yeah, and if you leave those around, we got people in here all the time. So we'd like to keep people connected to what you guys are doing. So Sherry, good question for you. So you talked about, I think you said 16 years ago, I think that was the number you threw out when the women's network
14
years ago when the women, and it's because there was clearly an identification of disparity or discrepancy in terms of the number of women that were involved in the capital ecosystem and so on. I think today we're seeing that same, just, when we talk about equity, let's talk about a different kind of equity. We talked about gender equity in terms of a lot of the women's programs. We still see a big gap in terms of racial equity, in terms of, and it's not just the funding. One of the things that we hear, the funding won't get better until the representation of funders starts to change as well. So as we grow angel networks, as we grow the investor side, what are we doing about ensuring that representation matters on that side of the table, and ensuring that we get a more diverse set of funders and angels and people who are actually making decisions on who gets money on the other side of the table?
Yeah, so we are very intentional. And do have good representation with the Women's Capital Connection with women of color, which is creating a very intentional way of reaching out to entrepreneurs across the Midwest. So it's certainly improving. There's always more to do. I would say that we have to be intentional about it. There's absolutely no reason not to be. It's the right thing to do. We have actually trained, though. When we started, we might have had 2 women in the Kansas City market that even understood what angel investment was. And we've probably had over 120 women that have been angel investors over the 14 years. So we are constantly educating, and that education can happen without people actually becoming an angel investor, which I think is also another opportunity to be broader in that education.
Yeah, and I would say we need your help in doing that. If you came to an MAA meeting I mean, it's typically a bunch of old white guys, right? Which has been the tradition. So we need to find angel investors of color, whether they get involved with MAA or they start their own chapter. Doesn't really matter to me, but we need to get that. We need mentors of color because we found entrepreneurs of color would love to be mentored by somebody that looks like them. We need to help. We need help doing that. And, that Johnson County thing that I have to deal with always seems to be, oh, you're over there on Johnson County and you got everything you need. That's not true. We work, Dan Smith and I at Porterhouse, when we first met and we sat down, I shared with him, look, I tried to get a version of the sandbox started that would be Troost only. And I said, but you're not going to look for the same companies that the digital sandbox looks for. You're going to look for who can start in that area and stay in that area. And I said, if you can make that happen, I'll help you any way I can. And then through connections with Maria, they start the Alchemy sandbox. I mean, that's the stuff that we need to do, which requires all of us to work together and say, if you want to start a angel network of investors of color, we don't have to do it. We'll certainly help you, and we know how to do it. We know the tools. We'll help you get it started, and then we can all look at the deals together. So some of it is this, I've been here forever. So some of this traditional lines that we still haven't broken down drives me crazy.
Yeah, there's a reason Keystone is where it's at. There's 100% reason why we're here, and our mission is innovation for all. And so one of the things, a couple challenges and the request for assistance, consider it done. It's one of the things that we're here for.
Which is why when you asked me yesterday to come down,
I know,
I could rearrange things. I said, what we need, and then I reached out to Sherry and said the same thing about, hey, if you're available, join me, because, there's just so many hours in the day, but we need to be interacting down here, even in, you talk grand views of the world, wherever. We need to all be interacting, because I've found that's where the ideas get shared, and you go, and if there's no feeling of, hey, I own this thing, so you can't have it, we can do great things together. And it's like, take this and run with it. And, Sherry and I, we have a small staff, so we're like, we can't do it all. So if we hear somebody goes, I'll take it, do it, we'll help you, go do it well, and just tell us who we should direct to you, and vice versa. So
yeah, let's find a path. Because I think one of the frustrations that I've seen in the community, one of the things that I hear most often is, we're going to stop focusing on tech entrepreneurship. We're going to start focusing on inclusion. And to me, that's then, but those are two different things. Focusing on equity and focusing on inclusion, and then turning all of your attention to Main Street business is perpetuating a stereotype that we can't have BIPOC tech founders and we can't grow wealth through innovation economy and the future of the economy in the United States, instead of just focusing on trade skills and Main Street business. Not that doesn't need to happen, but we can't say we're going to pick a path and not include everyone in the tech, innovation, research, science, technology-led path, and that's what we're trying to do here. So would really love your assistance in really trying to build that ecosystem here and make sure that's accessible to everybody. So just wanted to make sure, I put that out there for you guys. As well. And then I'm happy to help, and I think anybody, that's one of the reasons that we have the partnership with Black Excellence KC here, is to, provide that path and that access to those young professionals who could be future angels, and those young professionals who are, engaged in, these opportunities, and see this as well. And how do we, continue to take people upskill and upscale people into, wealth generation? It doesn't have to start, at the safety net.
And when you look, Cherry mentioned it earlier, I think angel investing has to find some investment instruments that don't require you to exit your business to return. Now, maybe it's revenue share, those things, but there's probably other things that I'm not smart enough to think of to go, how can I help somebody get a tech business started in this area, and then not 5 years, 6 years down the road go, you need to be acquired, because if you're acquired, they're going to move you somewhere else. It's like, no, how do I, whether it's dividend or whatever it is, how do I pay back that investment and keep that business in the areas that we want to keep those businesses? I've lived here forever, and I don't know how many different 18th and Vine projects I've lived through, but we still haven't got the vibrant community we need in these areas. And I'm a big believer that we need everybody to be an entrepreneur, color, age, whatever, if we're going to sustain this and not get sucked in this trap that Panasonic type deals are the answer. They're not.
Yeah, no, I totally agree. Hey, on short notice, thank you both for participating tonight. Thank you for being a part of the conversation. I truly appreciate it. And I want to have you guys back to have another conversation sometime soon.
Love to.
So thank you again. Appreciate it. And, keep
Thanks
doing
for
what you're
having
doing.
us.
Yeah, absolutely.